is Stevie Cohn, and I'm the Director of Sustainable Finance of GRI. And I'm really excited to be moderating this panel discussion on physical climate risk adjusted models, moving from theory to reality. Physical climate risk has moved rapidly from the academic arena into the mainstream of risk management, driven by escalating losses and increased regulatory scrutiny. Integrating physical climate risk into financial models is now a pressing operational priority. Organizations are moving beyond conceptual frameworks to embed climate hazard data, scenario analysis, and loss projections directly into underwriting, pricing, and portfolio management. Today we'll explore how leading organizations are turning complex climate science into practical tools for decision making. We are fortunate to have with us today 3 leaders in the space, bringing a breadth of expertise to this discussion. So first we have, to my direct left, Kathryn Bakos is Managing Director of Finance and Resilience at the Intact Center on Climate Adaptation, where she leads pioneering research at the intersection of climate and finance. The GRI and Intact, along with Kathryn, have had a 6-year partnership, and we're very pleased that Kathryn can be here today to share her perspective. Jean-Philippe Daigle is Vice President and Chief Risk Officer, Property and Casualty Insurance at Desjardins, bringing nearly 20 years of experience in the P&C industry. He previously held senior actuarial roles and risk roles at IA Financial Group and serves on the board of Facility Association. Josh Picov, furthest on the left, or my left, sorry, your right, is Executive Vice President of Global Operational and Enterprise Risk Management at CIBC, overseeing operational risk across cyber, technology, people, and processes. He previously held senior roles in personal and business banking and client-facing roles in capital markets, wealth management, retail banking, and the Office of the CEO. So thank you all for being with us today. Before we launch into discussion, each of our panelists will share some introductory remarks, starting with Kathryn. Great.
Should I stand? Should I sit?
If you would like to stand.
I think I'm going to stand just because we're going to pull up some slides here, or just one slide. So good afternoon, everyone. As Stevie said, my name is Kathryn Bakos, and I'm Managing Director at the Intact Center on Climate Adaptation. For those of you unfamiliar with the Intact Center, we're an applied research center housed out of the University of Waterloo that helps homeowners, communities, businesses, and governments reduce risks associated with climate change and extreme weather events. That's particularly in relation to flooding, wildfire, and extreme heat. So extreme weather events, they're becoming more severe across Canada and globally. These events cause power outages, supply chain impacts, evacuations, socioeconomic implications, and loss of life. And so that's what I'm here to speak with you all about today. My fellow panelists have been very kind. They've allowed me to go first to really set that foundational context of our panel discussion. So I'm going to be talking about the evolving nature of climate change, the financial costs of extreme weather, and what resources are available to reduce risk. And I'm going to do all of that in about 7 minutes. We have a lot of ground to cover, so let's get right to it. I'm sure everyone in this room is very well aware that climate change is real. It has happened, it is happening, and it will continue to happen. Now, what's often not spoken about enough is that a certain degree of climate change is already baked into the system, and therefore it is in fact irreversible. We can slow down the rate of change, but we cannot reverse it, at least not with the technology that we currently have. And we understand that the leading cause of this change is the burning of fossil fuels. So globally, we know we have to mitigate against greenhouse gas emissions, but we know we're nowhere near meeting the targets of the Paris Agreement, keeping temperatures below 1.5 degrees Celsius and achieving global net zero. But mitigating greenhouse gas emissions, this is incredibly important because it's going to avoid the worst impacts of climate change in the future. But we do have to recognize this is not going to stop or reverse the damage that has already been done. And therefore, adaptation, building resilience at the level of our homes, communities, and across our businesses needs to be a much more important part of the climate change discussion. And yet we know that adaptation financing, planning, and implementation are all plateauing. We are not putting enough resources towards adaptation here in Canada and globally. And yet we also know that for every dollar that we put into place for adaptation will save us, on average, $2 to $10 in cost avoidance over a 10-year period. So climate adaptation, it is the cost-effective strategy when year over year, the costs associated with climate change continue to increase. So there is no better witness than the impacts of extreme weather than the property and casualty, the P&C insurance sector. So for those of you unfamiliar with this graph, this is the catastrophic insurable loss claims for Canada. A CAT loss is any event, flood, wildfire, hailstorm, windstorm, that triggers $30 million or more of insured losses. Now just to orientate everyone on this graph, on your x-axis you have years, and on your y-axis you have billions of dollars worth of losses. CAT losses in Canada start to be calculated in 1983, which is the start of the graph. And up until 2008, which is just outside of this gray box region, losses range from approximately $400 to $700 million per year. So that's what all insurance companies would pay out due to extreme weather events. But everything really started to change from 2009 onward, and you can actually see this discernible upward trend in losses. Losses now average approximately $2.8 billion per year, with 15 out of the 16 of the last years being above $1 billion. Last year, 2024, losses reached $9.1 billion, ranking at the worst loss year in insurance history in Canada. Now, there's a few things to note about this graph. One, it is corrected for inflation and per capita wealth accumulation, so we are looking at a comparison of apples to apples year over year. This trend line is also very important. This is a curvilinear trend, which means that losses are increasing faster and faster year over year. So 2024 is the worst loss year in insurance history in Canada. In a few years, that's not going to be the case based on this trend line. These are also insurable costs, but that doesn't represent the full cost in the system throughout Canada. So the rule of thumb is that multiply these amounts by 3 to 4 times, and what you get is uninsured losses. So let's take 2024 as an example, $9.1 billion. That would be $27 to $36 billion coming out of the pockets of individuals, businesses, and governments. For governments, that's money coming out of budgets for hospitals, schools, infrastructure development. For businesses, that's money coming out of budgets for business expansion, equipment upgrades, employee compensation. And so we have to be thinking about the opportunity cost that is being lost because of extreme weather. Now, year over year, we can actually begin isolating for the different types of extreme weather events and figure out where the greatest costs are coming from. And year over year, without fail, we know that flooding is the costliest extreme weather event impacting Canada. From an insurable perspective, that's flooding manifesting itself at the residential home level, specifically basement flooding. And from an uninsurable perspective, that would be impacts to infrastructure, buildings, roads, and bridges. Now let's just focus on the insurable costs, because from an institutional perspective, that's a little bit more important in this case. We know from the Insurance Bureau of Canada that approximately 1.5 million homes, or approximately 10% of the Canadian housing market, is currently uninsurable for flood risk. Desjardins Financial last year just stopped offering mortgages in certain high-risk flood zones. So we're not just talking about the uninsurability, but the instability of the Canadian housing market. And if we use insurance in the residential housing sector as proxies for the growing risk in the system, we know most, if not all, other industry sectors are also being impacted. So this is where I want to leave you with this thought. What I often hear is, well, we need to do more research. We need to understand what the risks are, what measures we need to put into place to reduce that risk, to be able to price that risk accordingly. And yet here in Canada, we're actually in a very good position. So this is where our team at the Intact Centre, we actually excel at this. We work with standard setting bodies and subject matter experts from across the country to develop practical, meaningful, and cost-effective ways to reduce extreme weather risk. We know what to do at the level of the home and community in regards to flooding, wildfire, and extreme heat. And we've even developed tools, which I'm happy to talk about during our panel discussion, in regards to helping companies operating across industry sectors identify the key physical climate risks that could impact business operations, but more importantly, what measures need to be put into place to reduce that risk. It's only so much to price risk, we also need to be getting risk out of the system. I'll end it there, but looking forward to our panel discussion. Thank you.
Thank you, Kathryn. That was fantastic. Thank you for that foundation. Jean-Philippe?
Thank you, Stevie. Thank you, Kathryn, for the introduction. I'll start by presenting a little bit the context of Desjardins. I'm the CRO of the subsidiaries of General Insurance, P&C General Insurance. We are the third largest insurer in Canada. Activities across Canada, all around Canada, personal and commercial line. DGIG is owned by Desjardins Group, which is the largest financial cooperative in North America. What you mentioned was pretty right, and you give a good executive overview of the challenge. And I think P&C insurers in the past and still today are very good to manage natural disaster. That's why we exist. That's where people give us premium to be there in case of those situations. But by the curve, and usually when we see those curves and graphs, we are happy because usually it's growth or profit. But now we need to see it on another direction. That's very bad. So we need, as a P&C insurers, also to adapt, find solution, work with university, with our members and clients, to really understand how we can leverage that situation and fix them, or at least mitigate it for them. So I think I had the slide too, but maybe didn't do the cut. The way we addressed it at Desjardins was determining a few themes that we wanted to tackle, and the way we addressed it at first was really to put the member and clients at the front. So what is needs, what they understand of the situation, how it affects them, and are as a P&C insurers who can really help them to become more resilient. Because at the end of the day, I think everyone would like personally to be more resilient, but we don't know what to do. We are not aware if we are in a flood zone or not, or if we are at risk at something. So that's the way we tackle. So for sure, we put, let's say, a really pragmatic element in place, some program on some high-risk areas to remove or to give them incentive to become more resilient. And next time they have a claims, but then it will reduce costs. And there's also something very simple: just alert them. So put it in your app, little notification. Hey, by the way, there is a climate event coming from in your home in a few hours. Here's some tips, advice to mitigate the loss, and you do the job. Those are simple elements. People are just not aware, and they just want good advice to mitigate the losses. So at the end, we are maintaining a premium affordable, and we are reducing losses and operational burden into our company, because those huge catastrophes ask a lot for a P&C business, because all employees need to work answering the phone, managing the claim, managing the anxiety of those member and clients that are feeling the event, and they don't know what to do. For sure, the second element is leveraging model, and that will be the case, the main of the discussion. So our P&C insurers are currently using an enormous level of data that we have over time, and that we leverage in our day-to-day operation. And on the other side, for sure, managing disclosure, legal requirements, and also as a corporation, making our part, putting targets into the operation to reduce CO2, carbon. Yes. Carbon footprint. Yes, thank you. And so those are elements that are there too. Maybe to close my opening remark, and I think you did the bridge. Insurers are in the front row of the climate change right now, so they are absorbing the impact most of the time. And the main challenge that we see, and we'll discuss it, it's really about the affordability and availability of those coverages. So what if in a certain world there is no possibility or no availability of those coverage? The risk will be transferred to other mechanisms or other financial institutions into Canada and into the world, and bank could be now directly impact on those elements. So it's not an insurance or an insurer issue. I think that's really a global issue that we need to tackle and find solution together to solve it or mitigate at least it.
Over to me. So I'm going to start with an observation. My first observation is, you said experts on this panel. these two are experts. I almost feel like I want to move my chair over and grab a lower chair because I'm learning. And I mean, this is a slide that was up there, Kathryn, that you had is exceptionally powerful, right? To show that these once in 100-year events are no longer once in 100-year events. And as a bank, we're trying to figure out how we deal with all this. You know, both of my panelists have lots of experience, have the data required, and a bank is a little different, right? I mean, we do not have the level of detail, the level of data, but we're still at the early days of figuring out, okay, what does this all mean? There's the physical risks, there's transition. I mean, we're focused on, and we're looking at this as a journey, right, over time. We've got a lending book that, you know, we continue to focus on and come up with different ways of looking at it. And we've had to split it into two. If you think about our wholesale lending book, our carbon footprint is something that we've been paying a lot of attention to. On the retail side of it, we've thought about it from both the dimensions of physical and transition risk. On the transition risk, you think about housing is still a huge emitter into the environment in terms of the climate risks that go on from a societal effect perspective. But the physical risks are even more important. And seeing what I just saw there, really, like, that actually does frighten me. And why it frightens me is because, you know, especially Jean-Philippe, I think about what you do. You're pricing the risk in every day. You think about, and we were discussing, a few of us before this, around some of the risks on individual houses and how you make an assertion that you want to, you know, provide insurance coverage on it. When I think about it from a lending perspective, you know, to even say that we have good MSA data, we wouldn't have better MSA data than any publicly available sources. And the maturity in terms of where the mortgage market is right now from a physical transition perspective at banks is growing. So we think about it through four lenses: the regulatory lens and change, technology changes, market changes, and most importantly, reputational risks around this. And that's a double-sided, a double-edged sword. And I mean that because you think about how do you help clients move over time. At the same point, you don't want to create stranded assets, right? And unfortunately, and we'll talk a little bit about how we try and think about starting to model these things. There's two dimensions to how we lend: probability of default and loss given default. The challenge you have, and I'll talk a little more, as I said, later on this one, the probability of default is where we start to get ahead of this curve around lending into a physical transition space. The loss given default is 100%. It's 100%. When you have a property that's no longer insurable, that property is unfinanceable, and likely if there's an event, I'd say most of the people that are in a property like that probably couldn't self-insure. So these are things that we think about in terms of how to get ahead of this risk, but highly reliant on our partners. I think, you know, it's important. We've seen great regulatory guidance around this. You think of some of OSFI's B15 adaptations and how banks have had to start thinking about physical transition risk. We've been modeling climate stress for many years. It's not a new thing at CIBC. You know, we started this, and I was looking, I can think about the ones that I saw after the Calgary floods over a decade ago. What does that mean for our lending portfolio? What do we have in terms of mortgages or other loans to the area? And what could that mean from a loss given default perspective? Again, those were early days. But as Kathryn showed, with the escalation of events and the pace increasing, those models probably look very different now. And it's something that we continue to evaluate. So, you know, I think we're going to continue to work in partnership with various constituents to make sure that we're trying to stay at the leading edge of it. But I think for us as a bank, information remains key. And these are not pieces of data that we've trafficked in historically, but as you've seen, are going to have to start to focus on in the future.
Fantastic. Thanks, all of you, for the really good context for this discussion.
Can we stop? Or?
I think they'll come. So we're going to go into a Q&A panel discussion, and then we're going to be very excited to have questions from the audience, but please hold those until the audience Q&A. So, Kathryn, as you highlighted in your introductory remarks, the cost of extreme weather has risen dramatically in Canada. Understatement. From your research perspective, what's the biggest disconnect between how we understand physical climate risk academically and how financial institutions are pricing them today?
Yeah, I think that's great, Stevie, and I think there's a few factors at play here. One of those is exactly what we were just talking about, availability of information, and then the application to actual operations, operational implications, and then pricing. So we could use the catastrophic loss claims, like Josh, what you were saying, like that's, the information is there, it's publicly available. My hope, or I believe most P&C insurers are using that. But when our team engages with life and health insurers, with banks, with credit unions, that is new information, which then tells me that is not being incorporated into pricing. So how do we acknowledge what is publicly available? Again, if we're pricing assets, there is information to actually pinpoint exactly what those impacts could be. Also internally, as institutions, we have a vast amount of data that we could either be internally analyzing or engaging with external partners like research groups to be able to do that analysis. And a really great example I want to share with you is actually some work that the Intact Centre is currently doing. We've partnered with a life and health insurance company here in Canada. Stevie, you're familiar with this because GRI is supporting this initiative. But we've partnered with this life and health insurer to provide us with anonymized data to determine how extreme weather events, particularly flooding, are impacting medication, therapy, and disability claims. And through our analysis, we're going to determine whether there is actually implications to life and health insurers who may have previously thought, well, we don't insure property, extreme weather risk doesn't impact our operations. What we're trying to prove, our hypothesis, is that it actually does. So the availability of information, or how are we using that information? I think another factor is also how are we analyzing that information to then price that risk accordingly. Most institutions are engaging with scenario analysis, and I'm going to oversimplify this, but scenario analysis is basically looking at your exposure, your impact, and your vulnerability. So imagine we're doing analysis on a given asset in regards to flooding. Well, our exposure is going to be, well, what floodplain do you exist in? A 1 in 100 year, a 1 in 20 year? So based on the probability of occurrence, we can price that risk accordingly. Impact, what's the percentage or dollar value impact for that given asset? There's really good information across Canada and globally for how assets from a financial perspective could be impacted. But when it actually comes down to the vulnerability, you could have two assets, exactly the same assets side by side. So their exposure is the same. They're in the same floodplain. It's the same asset, so their impact is the same, the potential impact on dollar value or percentage value. But when we actually look at vulnerability, has one asset put measures in place to reduce risk and the other has not? Well, those are two very different risks in the system. And so unless we're asking questions of issuing companies or asset managers on whether they're taking actions to reduce risk, we don't fundamentally actually understand what those risks are in the system. So we need to be better informed and asking better questions. And as institutions, as trusted sources of information, we actually need to be providing asset owners and managers with information on ways they can reduce risk. Again, we don't want to just be pricing risk, because then we're going to price ourselves out of the market. We want to make sure we're reducing risk as well. And yet what's really interesting, and OSFI, the Office of the Superintendent of Financial Institutions, their standardized climate scenario exercise, which was just released last week, the majority of institutions have said they have no intention to share information with their clients on what they can do to reduce extreme weather risk. So what are the questions that we're asking, and then what are the resources that we're providing? And finally, and this just builds off of Josh's points, where are we directing our assets? Where are we investing in? And we know with public or private financial flows, when we're looking at climate investments, the majority of funding is going to mitigation. There was really interesting analysis done by Climate Policy Initiative, and what they said was globally, $1.2 trillion is being directed towards mitigation, while only $63 billion is being directed towards adaptation. We are going to analyze the risk of which we are investing. If we're investing more in mitigation, we're going to be analyzing that risk from policy, technological, market, reputational risk. And yet I always say to asset owners, you can reduce your greenhouse gas emissions and yet still be impacted by the impacts of climate change. So we need to be focusing more on adaptation when we're analyzing risk.
Fantastic, thank you, I love that. I love the reiteration of the what gets measured gets managed, as everyone here. So one of the themes coming out of this is the critical importance of quality and available data. So we'll touch on that a bit later. But first, Jean-Philippe, as an insurance executive, You've been pricing weather-related risks for decades. What are the core principles of physical risk assessment in insurance that financial institutions should understand as they evolve their own models?
Yeah, good question. And Kathryn, I think you hacked my sheet because
Sorry.
second line, hazard, vulnerability, and exposure framework. So, and it's key. But before that, and I'm a French speaker and I like to have short words because they are easier for me. I would say the obvious one is data. That's really something that we need to gather, and there is numerous source of data available. Some, like you said, are aggregate, so they can give you a flavor, they can give you a perspective, can help you with the strategic decision, the objective, the ambition of your institution. But if you want to be good at pricing and really doing right decision between one home and the other, you need to go further and then have access to detailed data. So like any other model that we have, we start with a hazard vulnerability, and I said that long words are difficult for me. Vulnerability and exposure framework. That's the foundation of how we are modeling those events. And I give you an example as a P&C insurer in Quebec, but also a big market share in Ontario and other provinces. Flood in Quebec, that's a risk that we are following carefully for obvious reasons. And like you mentioned, floods, it could be like all block or mini blocks, or it could be only a street, or it could be a home versus the other. There's many ways to explain that. There could be the way the infrastructure is done in the soil. It could be the one have mitigation measure, but the other doesn't have. Is there other reason? How profound the house is in the soil? So there is many parameters that we need to have to be able to do those decisions. So we need data, and those data, some are available into model, some we need to ask and trust the homeowner that he knows his home enough to be able to answer to them. And then we are cross-checking those information with different sources to then at the end decide, do I have the correct price for it? Will I accept the risk? Do I have put exclusion? Or do I give advice to that homeowner to say, I will insure you if you're doing that, that, and that. So that's really the role of the P&C insurers when you are underwriting risk. Another element that I think it's important to help maybe other institutions to have better understanding is really, understanding the building code. And we can influence the building code as an institution. So if you can have discussion with government, with other association, and we started discussion with some entrepreneur in some provinces, and they were not just aware that there was like some solution, sample solution that they could add in the way they are building new home or renew those homes to, that bring value at the end for the ending customer. And as their business perspective, that's good because they have also options available, and some people are anxious about those events. And if you arrive with a solution, but it's good for you and it's good for the society. So if we are able to get a building code that has, let's say, an enhancing and really incorporate those mitigation measures that many institutions in Canada are defining, that could really help institutions that don't have granular data to be able to assess better the risk.
Thank you, Jean-Philippe. So again, data coming to the forefront, and I think also interesting to highlight that sort of awareness or education gap, which is something we'll also touch on in a little bit. So question for the whole panel. Modeling physical risk creates unique challenges. For example, acute events like floods versus chronic trends like heat and sea level rise, as well as correlated losses across traditionally diversified regions. How can financial institutions balance these time horizons and rethink geographic diversification when assessing portfolio level exposures? Does anyone want to go first?
I can start. geographic diversification for P&C insurers is key. For a person that is doing business in Canada, the fact that we had, let's say, 2 earthquake region, there was different climate, different concentration, different type of business has been key to the model for many years, and it's still key. But when you're looking at those graphs, and you see not only the severity, but also the frequency, and the fact that it's not always in Quebec. It's always, it can be in British Columbia, it can be in Alberta. We've seen it in Toronto many years, and still continue, and we see it in Quebec. So, and we already always seen those events as independent. But maybe study at a certain moment will help us to understand maybe is there correlation between those events. Is there some place that the fact that it's warmer or it's more harsh on the climate and the other are more humidity? Will it be a certain correlation available at a certain point that we will see, oh, they are not as independent as we think. So for me, as of now, there is no, let's say, concern. I do believe that there is still a lot of diversification, but that's something with time, with the graph that will continue, that we need as an industry to assess and be able to really tackle it and confirm that assumption.
You go. Yeah.
No, I was just going to say that, again, and Jean-Philippe, you were saying that, again, what is the correlation between these events? And we're seeing specific regions across Canada. It's not going to change. It's just going to exacerbate. Like, we know what the events are. They're just going to get worse. And I always feel like the depressing ones, I promise you, there's always good news. There's things that we can do to reduce these risks. But we are seeing the intensification of the events, and there are knock-on effects. One will lead to another. So as an example, as temperatures increase, that obviously dries out natural spaces. That's going to lead to larger wildfires. With more temperature, this leads to more lightning storms. Lightning storms are 50% of the cause of all wildfires from igniting. The other 50% is human-caused, but the 50% caused by lightning storms causes 80% of the damage. We've also been participating in over 100 years of fire suppression, so we haven't been going into communities to get kind of that underbrush, those leaves burning, strategically burning certain areas to reduce the fuel. With higher temperatures, this is going to lead to more precipitation falling, more water over shorter periods of time. So one will exacerbate the other, but we know where there are risks in the system. They're just going to get worse. Obviously, on a sector basis, depending on your time frames, certain sectors will be hit across different time frames. But the idea isn't necessarily, obviously it's very important to model and to figure out, but again, it's the idea of getting risk out of the system. As institutions, P&C insurers as an example, it's either we insure you or we're going to drop your insurance. There's a lot to offer in the middle. How, as institutions, banks, credit unions, life and health insurers, how are we getting information out to people to make sure they're taking action to get risk out of the system so we can price more appropriately, but also reduce the chances of maybe these tools, such as insurance, aren't useful in the future. So I always focus on the data, but then and the pricing, but what do we do about it?
So as a banker, we are definitely in a little bit more of a conundrum, right? And if I think about the risks at a bank, I mean, CIBC specifically, $260 billion loan or mortgage portfolio, good geographic diversification generally across the country. Having said that, we're obviously concentrated in larger markets of Vancouver. Toronto would be our biggest concentrations. There's risks and challenges to being concentrated. I think the biggest risk, though, as I see it, is that when you think about, unlike insurance risk where it's priced year to year for the most part, most clients in Canada, 66% of clients sign up to a 5-year contract with the bank. So 5-year fixed rate term mortgages are probably the most popular. I mean, we see that ebb and flow with variable versus fixed, but sometimes it's 3 years depending on pricing in the market. But we have a 5-year decision we need to make. And the challenge is, as we saw from that graph, it's a great graph, I'm glad you brought that up, you can't reprice it quickly, right? So, we made a decision last year, as the events in an area get more and more volatile, well, we're there, we're committed, and at the end of the 5 years, if something has dramatically changed, I come back to what that LGD potentially looks like if the PD gets higher, right? So as that probability of default rises, and it's not default in your traditional default, it's actually PE, it's probability of event, there's not much we can do at the end of it. So trying to stay ahead of it and do a better job of modeling it is an opportunity for banks. But it's a challenge, like I said, because it's not a year-to-year decision.
Can I just add on something?
Absolutely.
There was a really great report through the Bank of Canada a few years ago. They were analyzing the impact flooding had on the Canadian housing market. And one of their key findings was that there was enough liquidity in the system, say a flood event was to occur, that a mortgage portfolio likely would not be impacted because the homeowners themselves had enough liquidity to be able to pay for that event. But what they hypothesized and they weren't able to determine was what happens if that home experiences repeated events. And we're starting to see this. We're seeing this in Nova Scotia, we're seeing this in Toronto, Vancouver, various areas. Obviously with wildfires, there's exacerbated risk as well. We have enough liquidity for one extreme weather event. I mentioned from an insurable perspective, flooded basements. The average cost of a flooded basement is $54,000. Your insurance is usually capped at $10,000 or $20,000, so a homeowner can be on the line for $44,000. But that's once.
Right.
If it happens again, are they going to have that liquidity?
Yeah.
And we know before COVID-19, 50% of Canadians were living paycheck to paycheck, and we know we're currently living through an affordability crisis. There's exacerbation on people's assets. So I think that's consideration as well, that there's liquidity in the system, but how much after these repeated events?
Well, I think the one that scares me more is the prevalence of wildfires, to be honest with you. It's something that, again, I remember growing up, you'd hear about it once in a while. But if you think about, again, living in Toronto and seeing some of the impacts of, wind pushing in smoke, I mean, that's not something that we had to deal with, and we're dealing with it now year after year. So I think about some of the catastrophic events in Kelowna, in Jasper, and some of these regions, and I'll come back to, again, the 5-year contract that we've signed. So, we've made the decision we did an adjudication decision in 23. There's now 2 events in an area. It comes down now to you to take a look and say, okay, is this insurable, is this not? You decide, I don't really want to be in Kelowna anymore. It's not an area that we're really comfortable with, given our view is that the long-term impacts of wildfire are not going to be sporadic, or not going to be once in a while, they're going to be more constant. I'm in year 2 of my mortgage contract. What do I do, right? So that's where, again, it's the balance of how we think about it over time. So it's great to hear, and I do agree that the one-off event probably does create some amount of resilience for a client. It's what happens if it's the binary event, right? Where, again, it's not a flood basement, it's the house is burnt down, and we're still left with a $400,000 mortgage on a piece of land that probably no one wants to buy, and it's not a building that's insured anymore. That's a real risk that banks have to, but I come back to, again, from a diversification perspective, one-off events like that aren't the end of the world. It's not great, and I feel we're very well provisioned in general to reflect uncertainty. But again, in an ideal world from a business perspective, it's risk that we'd like to avoid, obviously, going into it. So it's how do you strike that balance?
And it's also the diversification of the risks themselves.
Yeah.
Because, and Jean-Philippe, you would be able to speak better to this than I would, but for flooding, you could not, and I had mentioned 1.5 million homes no longer are insurable for flood risk, but that doesn't mean you don't get home insurance anymore. If your dishwasher overflows, if there's a robbery,
Sure.
A home insurance remains in place even without flood insurance. The moment you lose wildfire or fire insurance, there's no insurance policy. You can't have an insurance policy without fire. So the risks are actually different. So then when your mortgage comes up for renewal, if insurance has been removed, you actually can't renew that mortgage because there's no insurance in place. And we're seeing this happen in the United States. Allstate, State Farm, they've removed insurance due to wildfire risk.
Hurricane.
So now we're coming to the point of, are these now becoming stranded assets that we actually can't get a mortgage or a loan on?
Fantastic, really good insights. And I know this panel is on, institutional risk management, but thank you for also kind of bringing the data home to how can, in terms of the awareness, how can we start bringing this, the severity of this to individuals and spark action and interest that way. So switching gears a bit, Jean-Philippe, what signals are you seeing in Canadian insurance that point to growing physical risks?
Yeah, thank you. I had a few sentences about the graph, but we spoke enough about the graph, so I go on another direction. I think what, let's say, not shake the temple more recently, but it was you referring to in the US, I would say the fact that some big players decide to remove for good or I don't qualify bad, but for, let's say, business perspective decision, they decided to remove from some states. That's a concern because that's where we're starting the discussion about affordability and availability. There's in Florida right now that the cost to insure it, they can get insurance in some cases, but the cost is just unaffordable. There is no person that will pay that amount of premium to get that type of insurance. So that's really a concern, and then it's where you start that banking side start thinking, oh, okay, what I'm gonna do in that territory, and the fact that you don't have, let's say, specific data, it's even more difficult. Will you do a decision based on a block, based on a street, based on a city, based on the states? So that's where those discussions are very important. In Canada, we are not there yet on an insurance perspective. There is some region known, but they were known for, let's say, many years, many decades. But we need to embrace the resilience principle as an insurance perspective, but also at the client perspective. And that's where we are shifting from, you mentioned earlier, decline or insure, but we are moving. We want to have a 0 and a 1, but also a 0.1, a 0.2, up to a 1. So there is scenario between I'm insure you and I'm not going to insure you that we need to define and clarify. So that's where we're starting the resilience program. So giving incentive to our clients in different area to change their roof, but with a different material, change their siding with different material to prevent hail, to have some, and I'm not a claim manager, but have backflow preventers and some pump really that make a difference between your basement will be flood or won't be flood. And those make sense economically. So there is, like you mentioned, those prevention measures. When you look at it at first, there's no way I will come back with my money with that investment. But if you look at it on a long-term value and the industry is all doing it, there is really value there on the total for the industry for sure. And just as a member and client perspective, having an insurer that cares, that call you to inform you that you have risk flood and we have solutions for you, it's changed the relation a lot and then increase fidelity with your clients. So that's very good to think about those. On the financial aspect, we saw the cat losses, but our reinsurers, so as insurer, we are also reinsured by others. They saw also those graphs. And for sure, the cost of reinsurance premium have exploded over the last years. And they started also to revisit the risk in Canada by including new exclusion, redefining what's a wildfire, what's the range that we accept, how many hours it would take. So those elements are now new parameters that we need to put in perspective when we are assessing our risk globally. And lastly, we start to see also companies really to raise awareness. I think the word is spreading, that you have a duty as an insurer because you have the information really to communicate with your insured to keep them informed, raise awareness. And there is also industry association like IBC that's becoming more present in that area. They did some ads recently, and I think those needs to continue really to raise awareness. Because at the end, I never experienced flood. I don't know if people in the room have experienced it, but we only see it in the news. But when it's you, that's where you, oh my God, okay, I didn't know, and that's too bad because that's too late. But we need to prevent them and have everyone do their part on it.
Thank you, Jean-Philippe. Obviously touched on some of the challenges a bit, but Josh, building on those signals, can you elaborate on to what extent they translate to differentiation among pricing, or what are some of the biggest challenges there?
I'd love to be able to say that the risks are being captured from a pricing perspective. I don't think the maturation in the market is quite there yet. I mean, you think about sort of the mortgage market, and I'm assuming at some point in everyone in this room's lives, you will have lived through that mortgage decision where you're getting your first house, you're getting your second house, and you're going to shop it around, and you've got 4 banks on the corner, around the corner from your house, and you're popping into each of them and getting a quote for pricing. And I don't know that the dynamics are there quite yet in terms of how you model that, and then ultimately how the market absorbs it. So, I mean, what could potentially happen is, I think, listen, we've got a very competitive banking environment in Canada. I firmly believe that. You see it when you go to price your mortgage, right? And you make decisions based on that basis point or two, right? So if all of a sudden the bank says to you, hey, I'm going to charge you 100 basis point premium for this physical risk that's in your neighborhood, in your region, and again, ours would probably be broader than a subset environment at this stage in the game, given the data that we don't have. I mean, that's going to probably alter your view of where you're going to bank today. Where I'm more concerned is it's that 5-year risk period that I spoke about earlier, and what ultimately happens at the end of the cliff, right? So if your event changed, again, using the example of a wildfire risk in your area, fortunately, you're not impacted by it, and you've been okay, but your insurance company says you're not insurable anymore. I now have a house that's uninsurable. It's probably an equity risk question. And, the 50% loan to value that you have on your house that it's come down to through amortization over time, is a bank comfortable being at 50% loan to value? Or are we really starting to think that this is unsecured risk? And what would I lend to you on an unsecured basis based on more, on different cash flow metrics, right? So I don't know that it's a pricing decision or a risk decision at the end of the day, but it's not, I'd say currently the market is not there yet, but as these events, as we saw earlier, become more rapid, we are thinking about it, and we're thinking about how do we get ahead of this, but at a balanced perspective, because at the end of the day, our job as a bank is to make sure that our clients continue for CIBC to achieve their ambitions, right? We want to make sure that we're giving good long-term advice, and pricing a client out of the housing market is not the best long-term advice, right? So how do we strike the balance of making sure that the right preventative measures are going in from day one on how you manage some of this transition and physical risk so that your house can be resilient to it over time? That's how I would prefer it to see coming in, versus it's the carrot or the stick, right? Like the stick is not fun. The carrot is much more focused on advice, which is how our bank would be thinking about this generally.
I think so again, talking back to your first question about kind of academic partnerships with financial institutions, this is where academic research, I think, really comes in handy if institutions are unable to do that themselves. Not to talk about our research group, we just happen, this is very applicable here, but at the Intact Centre, our team, we actually performed the first ever quantitative analysis in Canada, looking at the impact flooding had on the Canadian housing market. So usually it was just scenario analysis. Like there was no actual number, like tell me the number of what actually happened in the Canadian marketplace. And so what we wanted to determine was, well, how is the sold price of the home impacted, number of days on the market, number of homes on the market, how are mortgages and arrears impacted? And we actually were able to acquire that information. We controlled for the experiment. We actually had findings. And what we found was homes located in flooded communities compared to their non-flooded counterparts experienced an 8.2% reduction in the sold price of their homes. 44% less homes were listed on the market in flooded communities, and when they were listed on the market, they stayed there approximately 20% longer. Mm-hmm. So now we have a value that we can use in our analysis. Yeah. But when we looked at mortgages and arrears, it was really interesting because what we found was there was an impact to loan-to-value ratio, as you were saying. And that's important to both mortgage providers and insurers because rates depend in part on loan-to-value ratio. Sure. But if an insured property is compromised by unanticipated flood risk, well, lenders and insurers could erroneously be approving or mispricing mortgage rates and insurance premiums. So with that backdrop, now that number actually exists to include into calculations to say, okay, if a home was to be impacted, we actually have a value now. So we're in a better position in Canada because of just one value alone.
Right.
Yeah.
Yeah, really great statistics that really underscore some of the risk. but also ties into the last question I'll have for all three of you before opening up to the audience. And you've tied it really nicely to this one. So where do you see opportunities for collaboration in terms of the rich risk data insurers have and what banks actually need for their credit models? And who would be best to coordinate that collaboration?
Okay, so maybe I'll start this one. So I mean, absolutely. I mean, and it's an emphatic yes that we need to collaborate, right? Again, the insurance industry has been doing this for many, many years. Super rich data available that we need for various purposes, not just for modeling, but ultimately to make good risk decisions on. So there's the scenario testing, stress testing, being resilient, but then there's also making good in-the-moment decisions in terms of adjudication processes. So I think absolutely I mean, speaking from our bank's perspective and things that we are working on that obviously I can't talk broadly about, there is an openness to working together. Whether this is a utility-like function, that's something that would be very interesting, right? Because our bank would not be alone in the journey that we're facing. Now, listen, some banks do have P&C arms. We don't have one. So, maybe there is somewhat more richly available data, but I would argue this is a great utility function that would benefit the safety and soundness of the Canadian market, which to me screams like partnership, and how we do that is definitely right for the taking. It's just a willingness to do so, right? And figuring out what does that body look like? What is the information used for? And again, respecting all privacy that would be involved to any information. How do we then coalesce around this to make sure that we're getting to the right place from a balanced view of how clients can benefit and ultimately how the bank mitigates and manages the risk? So the answer is yes. I think it's important and would be happy to be part of that.
I think the answer would be, it's my opinion, the answer would be probably yes, but for sure, insurance data and modeling is a real competitive advantage that exists. And like you mentioned, there is a financial institution that have P&C insurance and then banking. We are one of those. And even in the same company, sharing data between branch, it's a burden. So even within the same company. But what we've seen in recent project was to use your talent, because as a company that have the two branches, you have P&C experts that are readily available to help you maybe on the other aspect. And it's not like the first reflex to go knock at the door and I have a project and I think you have expert in physical risk that can really help you to think about it differently. And we can really leverage that experience and expertise internally. And for people that don't have P&C arms, I don't come at Desjardins pick the talent, but there is talent there somewhere
with other institutions
that could definitely help you to redesign or rethink the way to catch those elements.
It's a great point you raise, and I think about sort of that competitive nature, right? Again, we're not in the mix of that, given that we don't have the P&C arm, but I think about the CBA, the IBC as institutions where we can try and deal with that kind of stuff. So maybe that's the catalyst that works with the insurance companies, the banks, and the government. I think the government also has a role to play in this in terms of that mix, but it's definitely a sensitivity that we would have to manage through.
And I think Jean-Philippe was completely correct. Like, at the end of the day, it is a competitiveness and it's a proprietary information. Like, insurers don't need to, and they should not be sharing that information. But Josh, to your point, what is publicly available that we can acquire, whether through IBC? CatIQ is an organization that puts together the graph that I had shown. There's a lot of publicly available information, and then how are individual institutions utilizing that for their own competitive advantage? Because if you're all using the same information, obviously you're going to have to figure out a competitive edge there. But that's why I go back to what are the questions that we're asking? How are we engaging with our clients? Like, it's as simple as an institution. You don't need a P&C insurer to ask your client, have you taken, these are the measures, these are the 15 things I've done around my home, let me price that risk. If you've done it and your neighbor has not, those are two very different risks. So we have, as institutions, the opportunity to ask the questions of those that are providing loans or insurance to better inform ourselves. And then, Josh, I think you're completely correct. What publicly available information is it? How are we engaging with communities? For P&C insurers, there's municipal insurance. So municipalities have a responsibility as well. and companies operating within those communities, they shouldn't just be thinking about their own operations. They should be thinking about the boundaries of the community in which they operate. Because you could make yourself resilient, but if your community isn't resilient and people aren't coming into work, your roads are flooded out, your bridges are burnt down. So it is an all, I don't like the term, but it is an all of society approach in the sense of where's publicly available information, how do we drive competitiveness, what are the questions we're asking, and how are we working with the communities and individuals to get that information.
I think that summarizes it well. I mean, climate is an all-out risk for everyone, right? And while we can do a lot locally, it is going to take the global village to deal with it. But to your point, we can only mitigate so much from a local perspective, and we have to continue to do that, right?
What's that line that you had? It's a global problem with local.
Oh, so when you're talking about mitigation versus adaptation, and when I speak with asset owners, I always say you can mitigate your greenhouse gas emissions, but it takes the world, it takes Canada, it takes the United States, it takes China to reduce greenhouse gas emissions to actually notice an impact. That isn't saying we should be passing the buck and not doing anything. There is a global responsibility, but adaptation is local. And if you take action at the local level, if you take action at the operational level or at the household level, you will notice immediate differences.
Right.
And so adaptation is local.
And mitigation is global.
Correct.
I love that. All right, so mindful of time, I'd like to open it up to some questions. So please put your hand up and someone will come to you with a microphone. Okay, maybe we'll go from front to back. It's arbitrary.
Thank you. Thanks a lot for your thoughts and insights. I'm Sonika. I work in the environmental risk team at CIBC. My question is to Jean-Philippe, but there's a little bit of context. So as a financial institution, we see that as P&C insurers stop insuring some properties, that risk shifts to banks. So my question comes from that point, and a very interesting point you mentioned that between 0 and 1, between not insuring and insuring, there need to be some other scenarios defined as 0.1, 0.2. What do you anticipate those scenarios could look like, and are other P&C insurers also looking at such scenarios?
Yeah, I think the industry is very active on that point because we understand the impact, and at the end delivering the message to your member and clients that I'm sorry, I won't insure you in 45 days. That's not something that we want to be, and it raises reputational risk and a lot of elements. So those scenarios that are working are really about how we can help you to become more resilient, because at the end, if you, I don't know the term mitigate or the other thing get used, but if you are installing at some point, renovating with those type of material, your risk is good. And so at the end of the day, it's very how we can collaborate with, maybe there's opportunity also with banks, but with the client at the end, are you able, do you want, I can invest with you, but you need to do those elements if you want to stay insurable into the future. So those are the type of scenario. And obviously we could reduce the limit. There is like other element, but at the end it doesn't serve the needs of the clients because they know the value that they need. And if I'm just reducing the limit, it doesn't help at the end of the day.
Thank you, that's very helpful.
Hi, I'm Leah Young with University Pension Plan. So one of the challenges we face with climate scenario analysis and kind of calculating the potential damages over time is that for physical risk, you don't really see material impacts until kind of medium to longer term time horizons, which seems to not match up with the graph you're showing. You showed us at the beginning of this session. So just curious to hear how, what is that disconnect? And, you know, is there something, I don't know, what can explain that? Or how can you integrate material impacts or see those over shorter to medium time horizons?
Yeah, so some of the research that the Intact Center has actually done, so one of those tools that I had mentioned in regards to engaging with companies across industry sectors, we developed a tool to basically identify the key physical climate risks that could impact any company operating within that industry sector, within obviously the geographic range of Canada. We were just looking at Canada. And then more importantly, what measures should I be putting into place to reduce that risk? Well, part of that research was actually doing analysis on publicly traded companies to see after an extreme weather event occurred, how was their share price impacted? Now, obviously, depending on the industry, you're going to have to use different types of calculations to be able to forecast out what the potential impact could be. So one of the companies that we investigated was a publicly traded utilities company. It was TransAlta out of Alberta. It just happens to be, they had good information. They had great disclosures, and this is another reason why disclosures through various frameworks and standard setting bodies is incredibly important, because as institutional investors, you want to inform yourself on what the risks are. Based on the information that we found, we were able to do analysis. We used what's called discounted cash flow models. So in a defensive industry such as utilities, it doesn't fluctuate as much with the business cycle. Because of that, we can forecast out what future values would be. So we used the impact from an extreme weather event that they publicly disclosed, and we were able to determine the impact on their share price. And what we determined was there was a material impact to share price after that event had occurred. Now, we didn't look at rebound rates, but what we determined was highly exposed industry sectors, utilities, transmission and distribution lines, they were impacted about 20 to 25%. Medium impact sectors, consumer discretionary, retail, as an example, would be impacted about 10 to 15. And then low impact sectors, healthcare, IT, would be impacted about 5 to 10. Now again, we didn't look at the rebound rates, how quickly it rebounded, with the assumption obviously it did rebound. But based on that analysis alone, you can actually do calculations to show impact to share price. So I think it's also the acknowledgement of what is the information that we're asking of issuing companies to understand. So it goes back to, are you asking issuing companies, have you identified these risks and are you mitigating against these risks? Because if either of those answers are no, that may influence you in whether you want to direct assets to that company, or as a financial institution, a bank loaning money or providing insurance, you may want to provide at a higher rate or a higher premium. Or if you are doing something about it, then I should offer it to you at a lower rate and a lower premium to incentivize that action. And Josh, you were talking about kind of how competitive the marketplace is. So you were talking about how do we price 100 basis points more? Well, I would flip that. If you're actually doing something, I'm going to offer you just a little bit less, but it may incentivize you to come with me. And actually, I'm buffering my risk even more. So again, I think it comes back to what are the questions that we're asking of issuing companies, and do they understand their risk, and are they mitigating that risk?
Great question and great answer. I know we're at time. We have the mic in two hands, so we'll take these last two questions.
Okay. So my question is around what happened in 2024. So there was obviously multiple events and 4 significant events. If you look at the most significant event that happened last year, which was a Calgary hail, which caused almost north of $3 billion worth of insured loss. There was a study that was done where they overlaid the footprint of the event at a I think the 1980s or 1990s, assuming that the houses were at that level, the losses were much lower, right? So basically what's happening is not only climate change is causing the losses to be higher, but urbanization and the densification is also causing these losses to be higher. My question is, why isn't there enough bandwidth spent on the urbanization factor, whereas there's a lot more emphasis on the climate change? Because we all hear about climate change, but not as much on the urbanization. And secondly, what do you do about it? Like, I mean, obviously, as a mortgage provider, as a PNC insurance provider, you have to bring in premium somehow. If your risks are concentrated in certain areas that are becoming more inherently riskier because of climate change, you're at a disadvantage. But also from a consumer perspective, you need availability of mortgages and insurance. So how do we round that triangle or circle or whatever that is?
I'm not sure I will answer directly your question, but I'll give you maybe two elements. So in terms of difference of cost, I think we need to have in perspective the fact that there was many claims, many catastrophe at the same time. So we saw building repairs, saw the hail in Calgary, and then there was the rain event in Toronto, moving person from one region to the other to help to support the other region. So there was like let's say a urge social inflation on those claims. So that's one element. As a pan-Canadian company, we have claims in Alberta, Ontario, and then Quebec. The team is doing his best, but there is delays in reparation, so there is some temporary costs that we need to pay to during that the claim is repaired. There is cost. I cannot give you my cleaning and everything to keep in place. So those elements could also explain part of why the cost was higher. What you send the data.
So maybe I'll just add to this. Not that I'm the expert in this space, but you bring up a very interesting dichotomy, which is I attended an event at a U.S. university last year talking about climate, and densification is required to solve the climate issue in terms of you need people living closer together, you need to have localized communities in terms of consumption, you need to minimize transportation, and you can only do that through densification. You then overlay that with event risk, and like anything, right, you think about notable events where there's a big amount of people in a very small area, the risks are greater, right? So it's how do you balance these two different things coming together, right? In one form, climatologists would say that, or you need to have everyone living in skyscrapers, right? No more of these individual homes. It's a poor use of densification. We can then electrify it very efficiently, whether through wind or through solar. So that's the one area around emissions. But then you take the physical risk part of it and say, well, what happens if that same block was to be hit by a wildfire or to be flooded, or something else happens from an event risk perspective? So, while not answering the question directly, I think it shows you the interesting parts of two different dimensions at play, right? The physical risk versus the emission issue that we're also trying to solve, and how do you deal with that collectively?
And just to add to your point about densification as well, and I didn't touch upon it, climate change is just a driver in the system. But to your point about densification, aging municipal infrastructure that never incorporated adaptation into decision making, the loss of natural infrastructure. Here in Southern Ontario, we've ripped up 70% of natural infrastructure and replaced it with cement. You have high precipitation events like what Toronto experienced last year. The water has nowhere to go but into people's homes. In regards to pricing, we could start looking at the age of municipality, and Jean-Philippe, I think you touched upon that. Based on the age of a community, you can actually determine what type of sewer systems they're using. And so what Toronto experienced last year was combined sewer overflow, high amount of precipitation. It basically pushes sewage through the rainwater systems because they're connected. Those piping systems are connected. Newer communities, they have, and so it's a high precipitation event. Those piping systems should be separated and actually increased in size for we're anticipating more rainfall over short periods of time. We can start using that analysis to map out communities to then potentially price risk. So that's how I would start thinking about it and incorporating it into pricing, at least from that perspective.
Thank you guys. So I know we're at time, but we have one last question. We'll give you your...
Okay, thank you very much. I'm with the Ontario Ministry of Energy and Mines. My question, I think, tags on to what you were just saying, and that's about the role of government. And because I've been puzzled for a while about the kind of slow progress of integrating climate risks into kind of financial calculations in financial institutions. And I wonder if there's a kind of an implicit trust that governments will take care of it in one way or another, either because of they'll act as a backstop to large events and bail people out, or secondly, whether there's a trust that governments will, if it was really such a big systemic risk, then governments would have done something already. Is this something that you're hearing or that you're experiencing, or?
Well, do you want me to start, or you want to start?
Well, I think there is a role of government. Again, I think as trusted sources, as we were talking about financial institutions providing resources to customers and clients, I think communities have a responsibility to provide constituents. What can you be doing at the level of your home? What should the community be doing? How are we prioritizing those actions? And we're seeing with the inaction, massive class action lawsuits across the country. We're in the Oakville room right now. Oakville had a class action lawsuit, a $1 billion class action lawsuit, which is now settled. Merritt, British Columbia, it just went into the news a few days ago. So people are suing the communities, the mayors, the conservation authorities to basically say, you knew there was risk and you did nothing about it. And so I do think there is a responsibility, but again, it's a spectrum from providing homeowners with information on what they can do to major infrastructure projects that cost billions of dollars. So it's a spectrum of actions, but we're in a really great place here in Canada. We have that research. We know what to do. We have resources to deploy. We just need to deploy them now.
And for sure, there is a a level of risk that insurers won't be able to capture. There was discussion, still discussion about the National Flood Program, partnership, private, public. So that's something for sure that needs to continue to be explored. There is other risk. We didn't talk today about earthquake, but that's another situation that could have systemic impact on the industry for sure. So they are there. We need to address them. How we can raise awareness and make sure that everyone understands them. I think we're working very good and very hard with the industry association, researcher, to give the visibility to the right person, but still work to do.
And just to wrap it up, we're generally not reliant on the government coming to save us. Like, we don't model that in terms of our own thinking. While it's proven out, if you think about the global financial crisis, you think about COVID and the pandemic and how the government stepped up. When we are doing, from a philosophical perspective, our modeling around things and stress testing, we don't model that the government's going to come in and do it. So important lever that can get pulled, but not part of, at least from a financial institution perspective, that our alliance that we're counting on to be there.
Thank you guys so much. So I know we're already cutting into break time, so I want to make sure you'll get a break. So thank you, Kathryn, Jean-Philippe, Josh, for just really great insights, a really good panel, and thank you to the audience for coming.